The big question is a housing crash coming? Today, we are looking at one of the biggest questions many Americans are asking right now. Will the United States housing market finally crash in 2026, or is something very different happening behind the headlines? Over the past few years, home prices moved very fast. After the pandemic, prices surged to record highs. Many buyers felt locked out. Many renters felt stuck. And many investors wondered how long this could last. Now, as we move closer to 2026, the market is clearly changing. Recent housing data shows that dozens of major cities across the United States have already experienced year-over-year home price declines. That means prices in those areas are lower than they were 1 year ago. However, something important has happened recently. The number of cities seeing declines has stopped increasing rapidly. This is a key detail. Instead of more and more markets falling each month, the count has started to level out. That does not mean prices are rising again everywhere. It means the pace of cooling has slowed. Many people hear the word crash and think of 2008. That was a sudden and violent collapse driven by bad loans, over-leverage, and forced selling. What we are seeing now does not look like that, at least not yet. Instead, this looks more like a slow adjustment. Prices are cooling. Sales are slower. Buyers are cautious. Sellers are no longer in full control. But the system itself is still functioning. The media often uses dramatic language because fear attracts attention. But real market analysis requires patience and context. We must look at inventory, mortgage rates, local supply, and buyer behavior together. One data point alone does not tell the full story. So in this video, we will break down the facts. We will explain what the numbers really mean. We will look at why some cities are falling while others are not. And most importantly, we will discuss what this could mean as we move into 2026. This is not about panic. This is about understanding reality clearly, calmly, and honestly. Inventory is changing the game. One of the most important forces shaping the housing market right now is inventory. Inventory simply means how many homes are available for sale. For years, inventory was extremely low. There were more buyers than homes, which pushed prices higher and higher. That situation is no longer the same. Over the past year, more homes have come onto the market. Some sellers decided to list because prices were high. Some investors decided to exit. And some homeowners were forced to sell due to rising costs. As a result, buyers now have more choices. When inventory rises, sellers lose pricing power. Buyers can take their time. They can negotiate. They can walk away. This naturally puts downward pressure on prices. However, inventory growth has not been equal everywhere. In states like Arizona, Texas, and Florida, supply has grown much faster. These markets saw some of the strongest price growth during the boom years, so they are now seeing more cooling. In contrast, parts of the Midwest and Northeast still have relatively tight inventory. In those regions, prices have been more stable. Some cities are even still seeing small gains. This is why talking about a national crash can be misleading. The housing market is not one single market. It is hundreds of local markets moving at different speeds. Another key detail is that inventory growth has slowed recently. It is still higher than before, but it is not accelerating the way it was earlier. This suggests that the biggest adjustment phase may already be behind us. That does not mean prices will surge again. It simply means the market is trying to find balance. Understanding inventory is critical because it tells us who has control. Right now, control is shifting away from sellers and moving toward buyers. That is a healthy change after years of imbalance. As we move toward 2026, inventory levels will be one of the most important indicators to watch. What the data really tells us. When people hear that home prices are falling in many cities, the first reaction is fear. But to understand what is really happening, we must look carefully at the data and how it is changing over time. Housing data shows that the number of major United States housing markets with year-over-year price declines increased through much of 2024 and early 2025. At one point, nearly one-third of large metro areas were showing lower prices compared to the year before. However, a very important shift happened recently. That number stopped rising. Instead of more markets entering decline, the count stabilized. This does not mean prices are suddenly booming again. It means the downward trend slowed. This is a critical difference. In a true housing crash, price declines spread rapidly from city to city. Momentum builds. Forced selling increases. Credit tightens. We are not seeing that pattern right now. Instead, the market is showing signs of price digestion. That means prices are adjusting to higher mortgage rates and weaker demand. But they are not collapsing under stress. Another important detail is that most price declines remain modest. In many markets, prices are down a few percentage points, not tens of percent. That matters. Small declines reduce pressure without breaking the system. We are also seeing buyers become more selective, rather than completely disappearing. Homes that are priced correctly are still selling. Homes that are overpriced are sitting longer or seeing reductions. This behavior suggests that the market is becoming more rational. The extreme emotions of the pandemic boom years are fading. Fear of missing out is gone. Patience is returning. It is also important to remember that housing markets move slowly. They do not change direction overnight. Stabilization often comes before either recovery or deeper correction so far. The data suggests a cooling phase that is losing momentum rather than accelerating, that points more toward a plateau than a crash. The next question, of course, is what role interest rates will play. That brings us to the next part of the story. Mortgage rates and affordability pressure. Mortgage rates play a massive role in the housing market. When rates are low, buyers can afford more. When rates are high, buying power drops quickly. Over the past year, mortgage rates remained much higher than the historic lows seen earlier in the decade. This has had a powerful effect on affordability. Monthly payments for the same home are significantly higher than they were just a few years ago. This is one of the main reasons demand cooled. Many buyers did not leave the market because they wanted to. They left because the numbers no longer worked. However, high mortgage rates alone do not automatically cause a crash. What matters is whether homeowners are forced to sell. So far, that pressure remains limited. Most homeowners locked in very low fixed rates years ago. They are not facing payment shocks. As a result, they are not rushing to sell at a loss. This keeps supply from exploding. This is a major difference between today and past housing collapses. In earlier crashes, adjustable loans and weak borrower balance sheets created waves of forced selling. That dynamic is largely absent right now. Instead, we are seeing a market where buyers are strained, sellers are patient, and transactions slow down. Affordability remains a serious problem, especially for first-time buyers, that could keep demand muted into 2026. But muted demand is not the same as panic selling. If mortgage rates fall meaningfully, demand could return quickly. If rates stay high, prices may continue to drift or move sideways. Either way, the system appears stable for now. The housing market is under pressure, but it is not cracking. Will 2026 bring a crash or a reset? So where does all of this leave us as we look ahead to 2026? Based on current data, the housing market does not appear to be heading toward a sudden nationwide crash. Instead, it looks like a slow reset after an extreme period of growth. Prices have cooled. Inventory increased. Buyers stepped back. Sellers lost leverage. And now, the market is attempting to find a new balance. That balance may involve more flat prices. It may involve small declines in certain cities. It may even include renewed growth in areas with strong job markets and limited supply. What seems less likely? Based on today's evidence, is a dramatic collapse across the entire country. That said, risks still exist. Economic shocks, job losses, or major interest rate changes could alter the picture. Local markets with oversupply remain vulnerable. This is why national headlines can be misleading. The housing market is local. What happens in one city may not happen in another. For buyers, patience and preparation matter. For sellers, pricing realistically is more important than ever. For investors, risk management is key. The most important takeaway is this: the market is changing, but it is not breaking. Understanding the difference between a crash and a correction can save people from making emotional decisions based on fear rather than facts. As we move into 2026, clarity will matter more than headlines.